Well, good day, everybody. Welcome to the Monday Roundtable of Wealthpress. I'm here with Roger Scott, Jeff Zananiri, and Lance Ippolito as per usual. Gentlemen, how is everybody today?
Great.
Great. Thank you for having us here, James. Really appreciate it.
Great. So let's kick it off with the quick discussion about markets generally. It looks like we are looking at a bit of a warm open, and there is, the media sort of feedback is that we are basically expecting markets to be pretty frothy to the upside this week because of all of the reopening going on. Jeff, what do you make of that?
Sell the news in a sentence. We've been pricing in the reopening. I think we had a little bit of a talk this morning about some anecdotal experiences we've had in our own localities. And people aren't racing back into restaurants. Lance was saying in the west coast of Florida. Roger said the same thing in the north coast. And that's to be expected. So, you know, what I'm looking at, and what's interesting to me, is that there's been this huge underperformance through the whole pandemic in the U.S. in the Russell 2000 and smaller cap stocks. But the last week that kind of shifted. So we started to see the IWM and you started to see the Russell stocks starting to actually outperform the larger cap stocks, which is interesting to me because I think that it was a liquidity flow thing in the beginning with the Amazons, the FANGs of the world, because they're trillion-dollar companies. And when you're dealing with Fed liquidity, which is in the billions and billions, you can't put those into Russell stocks. You need big mechanisms of liquidity, like an Amazon that trades $10 billion a day notional, that has a float of $900 billion. These are huge securities in the world. They're global securities for that. So I'd be interested to see if the IWM continues, because that's kind of my canary in the coal mine as to how the broader market with the pandemic is playing out.
Hmm. Okay, Roger.
Well, I sort of agree with Jeff, but I have a different analogy, but our conclusion is the same. The way I'm looking at it is, and he's 100% right. The whole government aid and all of that was money going into the large caps. That's not money going into the small caps, or they're not really small caps. More of a medium cap. They got 2 billion market cap in the Russell, but still, aside from that difference, the logic is the same. But here's the thing: usually, as a rule of thumb, from my back testing and my analysis, we find that smaller stocks tend to decline quicker in a downside market, or to be the first ones to come down, and they're the first ones to go up because they are more speculative. And whenever you have speculative stocks and when you have less market cap, it's easier to cause upside and downside, obviously. Can you imagine a large fund coming into a stock that's worth 2 billion versus 100 billion? It's a whole different world. So I believe that it's a very, very powerful sign that small caps are coming up right now, because that means there is some liquidity and some capital coming into those shares. And that's very, very important. And that may mean the market is ready to move higher once again. Remember, small caps started lagging behind the market during the in 2018, November of 2018, right after we announced the trade war. So,
True.
because they take into account, they're not conglomerates. They're more one-trick
Yeah.
ponies. They've got a lot more to lose during this trade war. And now, for the first time since last November, we're really seeing them making a comeback. So this is very important. It's something I'm going to watch out for. And it may mean that stocks that are starting to rally again, because usually in the first stage of a bull market, we will see small caps begin that move. Speculative stocks always tend to go up first and go down first.
Hmm. Okay, and do you share that sentiment as well, Lance?
Yeah, so the Russell, we there's a saying, the Russell leads the way, and as Roger and Jeff were saying, the Russell's been lagging historically. And one thing that really caught my attention, and it's been really this dark cloud, is financials. Um, and during this whole participation, as Jeff brought up, it's been just a handful of stocks, your Amazon, Microsoft, Facebook, Apple, Google, really leading the way on this market higher. And if you look at, let's say, those names compared to financials, for example, they really haven't had that breakout yet from our whole post-corona crash. So I think if we start having banks rally, IWM rally, could be a really bullish sign for the market. It's just I think there's still a lot of red flags out there, especially with reopening the economy. And if the banks don't get some kind of bid, especially these European banks that have really came out and it's not looking good for them. And even here in the U.S. with Jamie Dimon of J.P. Morgan, the banks aren't having this very optimistic outlook. And I tend to agree with these folks more than the Jeff Bezos in the world. So I'm very cautious, but at the same time, it's hard to ignore what the market has done. If you look at tech, if you look at the Qs, and you see this rally, there's a little bit of fear of missing out. So people want to get back into stocks, and when normally people want to get back into stocks, that's a little bit of a short-term top. So I'm iffy on the market here. I wish I could, be more positive in outlook, but there's too many red flags for me to go and say, all right, I'm all in long.
Okay, so it's a positive development. The Russell turning more substantially green, but it's not the catalyst that we'd hoped it would be. Then, so what is your outlook on the next quarter? Say, we know that the economic data is not expected to be good. It's a question of how bad is it. But we've seen this real sort of divergence in what the stock market does relative to the economic data. And as Jeff and Roger initially pointed out, that's largely a result of the liquidity created by the central banks coming into the larger cap markets, sort of lifting all boats in the stock market. And so are we in this market now where the economic data doesn't matter? Like 3.2 million more jobless drives the market higher? Like, that's just so counterintuitive. But is it a new mindset that we have to adopt?
It goes back to the saying, I think, is bad news good news for the market, and is good news going to be good news for the market? It's really how the market, I feel like, interprets the news. And going back to earnings, every earnings report over the past few weeks, we've kind of gave a free pass to. Next quarter earnings are really going to capture what the real economy has done and all the jobs being lost and the businesses being shut down. I'm worried of this, that the market is going to take next quarter earnings and just say, okay, we'll give you a free pass, or analyst expectations are going to be so low that companies will come out with okay numbers and beat top and bottom just because expectations are so low. I don't want to see that. I actually want to see companies actually trade on their earnings. And I actually want to see, and we just started seeing this up until a few months ago, that bad earnings get punished. I would like to see that. I think that would be very healthy for the market. And some of these names that have gotten a free pass will so start trading at real valuations. That's what I would like to see. But I think we have to wait up until next quarter earnings.
And Jeff, are you trading actively at this point?
You have to. I mean, we're in the middle of a pandemic. People are trying to assign some sort of sensibility to what the market's doing and a rationale. Mansplaining PEs. Remember when Bitcoin came out and it went to 19,000 and people were like, well, all the gold in the world equals X, then Bitcoin should equal 100,000. And you can do that with anything. You can provide a rationale for any you can back one into any asset price. I don't like to think that way. I like to think more in terms of like math. Well, it went up 10% last week, then we can expect a 10% move this week. What I would say is that this is 2020. It's also an election year. We also have a trade war that's falling apart. If you think we're going to just like tap dance through this landmine of news that's coming out over the next 6 months, and you're just going to be like, okay, I'm buying these great companies because they have good balance sheets and I like their product, you're doing it wrong. You have to be tactical. You have to time it in those dips. If you miss those dips, you miss that trade. Wait for the next trade. Don't chase trades. The worst trades I've ever been involved in my life came from FOMO. You lose the most money by entering badly.
Hmm.
Do you hear what I'm saying? Like the
Sure.
entry, and the worst entries always happen when you feel like you have to get into a trade because somebody else has made money in it. It's the laziest thing you can do. It's like one of the biggest sins of trading. You missed a trade, you have FOMO, you want something to do, and you enter at a really, really crappy point. And then you're on just defense the whole time. You ever been in one of those where you're just like, oh my God, did I just buy that at that against all your instincts? You're like, your head's on fire with alarm bells, and you still pull the trigger because of that FOMO. And then you're out 5% within like 2 clicks. And you're like, oh shit, here we go. It was a trade and now it's an investment.
And
Yeah.
with options, everything you've said is just so much more magnified.
Exactly.
Yeah, you're buying those options that are, the IV is through the roof, and you're like, wow, I have to get in, I have to get leverage, and I'm gonna go big. And then you wake up the next day or two, and not only do you have an IV crush, but the stock is down, and your options are just absolutely crushed, and you're thinking, what do I do now? What do I do now? And we've actually seen that so many times with the airliners and other transportation names, that every time the airliners catch a bid, oh, look, Delta up 8%. I got to get in. Next day, down 10%.
Right. And they're making new lows all the time, right? They're making new lows. So they're doing it in reverse. Like if you're looking for short cases, you should be looking for the weak sisters that might be zeros, guys that they'll mail you the stock certificate as proof that the company existed. And you, instead of buying those on the up 10% day, maybe lace them out.
Right. Right. So what about specific names? Roger, you gave me a list of names last week, and I see that they're all looking strong a week later. I published a pick on the weekend for Quidel, which was the company behind the home testing kit that was approved by the FDA late Friday, and that's doing well. So I mean, there are sort of hit and run guerrilla style trades to be made opportunistically, particularly as pertains to COVID-19 related stocks. Do you guys have any other sort of sectors where people should be considering, or do you have any sort of general thoughts on opportunistic guerrilla style hits this week that maybe are overlooked by the mainstream?
Well, I'm looking at stocks right now that have strong consumer demand right now, and I mean right now. And when you talk about consumer demand, you could be thinking to yourself, what are consumers looking at? But you know what? Take a look at Clorox. Take a look at Campbell's Soup. How about Hormel Spam? People are buying that right now. There is a market for that right now. People are
The stock or the actual meat?
But both.
both. So there are stocks right now. I think the biggest problem right now is people are looking too far ahead for what they're doing. I think you have swing traders that are looking like investors, and you have investors that are looking like swing traders, and everybody wants to figure out what's going to happen in the future instead of looking right now at this at because the scenario we have right now is very specific, and there is this, see, in a broad bear market where economy sucks. Well, economy sucks. What are you going to do? There's less of liquidity coming into everything, but that's not the case right now. This is a health pandemic, so it's very specific. So you have certain sectors that are completely dead, but on the other hand, you have specific sectors that are just heating up like crazy, like defensive consumer sectors, like I just mentioned. The non-real estate specific REITs, like we talked about last week. There are some stocks that are making 52-week highs, that are going to be making 52-week highs, just like airlines and cruise ships are going to be making 52-week lows because of the scenario we are in. So instead of changing the scenario, we should be embracing the scenario right now while it's still here, because a year from now, we're going to be thinking back and saying, that was just such a clear period for me to be investing in Clorox. There was no Clorox anywhere in the store. Everybody was using Clorox. Clorox. Why didn't I buy some Clorox? Or why didn't I stock up on Campbell's Soup? Everybody's buying soup. We don't know how long this thing's going to last. We can't go out to restaurants. It was a no-brainer. take advantage of these situations now. Stop thinking ahead. We don't know what's going to happen ahead. The medicine doesn't know what's going to happen ahead. Doctors don't know we don't know when we're going to come out with a vaccine, how long it's going to take, whether we're going to get reinfection. Forget about tomorrow. Worry about right now.
What about you, Lance?
I like what Roger said a lot, because I remember watching just on the financial media, all the talking heads, people were making cases. There's no reason to get long Campbell's, or there's no reason to get long Kraft Heinz. There's nothing sexy about these things. There's no growth. Go and, find your next internet software darling. And it's not, let's be honest, it's not attractive to go out and say, hey, I own Campbell's soup out there, right? I'm going to get crazy growth on this name. But right now, that's where money is flowing into, is these safe asset classes. And if you look at, people always looking for the next opportunity or what's the next big tech stock, is you're having some of these names really, really get punished. And they're not coming back. The bad companies, they're not going to make it out of this, right? But your companies with solid balance sheets, solid fundamentals, that's where you should be allocating, especially these companies paying a dividend. That's where, money is being allocated to right now. So, something, we don't have a crystal ball. Nobody does. Nobody knows what's going to happen in the next, 5 to 6 months. So why, especially if you're a swing trader, why would you go and take a stab at, Carnival or an airliner out there? Because hopefully bookings go up. Like, I'm reading news on Carnival this morning, bookings are up 400% or something. Well, yeah, but how long is that going to last? Is it just a one-day event? And you have to be careful with short-term headlines compared to what is down the road in the next few months.
Sorry, what was the name you mentioned that's up 400%?
So Carnival came out over this weekend, and they said like bookings are up, what was it, 400% or something? Yeah, the cruise ship name. And
it's interesting that you mentioned the cruise ship, because as I mentioned to you guys, my parents were over my house yesterday for Mother's Day. My parents are huge cruise ship people. They love cruise ships. That's their thing. And I asked them yesterday, I said, are you planning on going on a cruise ship anytime soon? They looked at me like I was crazy. They said not for a long time. And these are people who are absolutely, it's like people who go to McDonald's every other day. They love cruise ships. So there's a lot. It's just like Lance said, there's just too much uncertainty with these companies that are out of favor right now. We just don't know what's going to go. And the fact that they're cheap, that's not a good reason to buy them.
What is cheap? That's the number one question. If Carnival's at 14, is that cheap? If it's at 7, is it cheap then? I don't know. 50% down, that's not cheap to me. I'm not willing to take that. If you are, great. Go run out, do what you want with it. And if you're an option player, you're going to go and buy a crazy IV in these options. Oh, I'm going to get long calls. And as the stock goes up, the call premium just gets crushed. I mean, if you want to sell puts and own these stocks, go out in time and sell that high implied volatility, but don't try to call the bottom of these names. I mean, I think you're playing with fire if you do something like that.
Agreed.
What about you, Jeff? Are you turned on by the 400% increase in bookings by?
It went from one guy to 5. I don't know. I mean, there's what is it?
With a beta group of 10
lies.
people.
I mean, who cares? Like, I like where both these guys' heads are at. They're trend players, right? And we're talking the same game. Like, don't try to reverse trends on losers in this new reality. There's going to be companies that don't exist. There's this whole concept of new normal isn't nothing. It's actually very real. I mean, in my community, in parenting, we have kids with friends. Like, everything is different. You do nothing the same that you did 3 months ago. So it'd be preposterous to think that people's businesses are going to be bulletproof. Right. I would say that because of the magnitude of the, Roger, I don't disagree with Roger that it's a medical crisis. But when you've lost 30 million jobs in a month and a half in the economy, it becomes something that's a little bit different. I don't think that we've really, even in the economy, fully priced how much pain there is for the broader consumer in person yet. I hope that it's something that's intermittent and just goes by. But when you take that many people out, I mean, I'm not unemployed. I'm sitting here making money, and I trade and make money. And I'm also defensive in my spending. My wife is like, let's do this or let's do that. I was looking at a blingy car 3 months ago. I'm glad I didn't pull the trigger. And you know, people that have income, that know how to trade, that have money, are defensive. What are the 30 million that lost their job thinking like, right? So to expect that spending and everything's going to be okay, it's going to be a little bit of a while. It's going to be an adjustment period. The thing between the winners and the losers, why I love where their heads at, is that flow of investment money is constant. That river is still going to flow, and it's got to go somewhere. That's why you're seeing so much capital allocated to these winners. And like, wait, I can't put money in something that's not going to exist. So I'll pay for a 35 PE Amazon or Facebook because I know they're going to be around. I don't know if AMC movie theater is going to be around in 2022.
Mm-hmm. Okay, interesting. No, this is fascinating to me because I'm, as you know, probably more of a investor. I like to deploy capital looking for a multiple exponential move over time based on a fundamental business case combined with a fundamental broader economic driver. So I'm looking at some of these smaller stocks that have got serious traction in the various categories of coronavirus stocks. So one I'm tracking has demonstrated nearly 100% efficacy in reversing the effects of the acute respiratory distress associated with acute COVID-19. Yet it's not getting the love in the market because it's an OTC backwater stock that, despite the fact that it has this drug in the marketplace that is actively prescribed and effective for things like HIV and even cancer, because this is an orphan stock. In other words, has no affiliation with any bank. It has no big investment banking sponsor. It has no relationship with any super major drug company. It's essentially treading water. And it's got this small following of people who are like, yeah, I see the data. This makes sense. I'm buying it. But it really can't get going because it's too far out of the comfort zone of the large cap traders who are like yourself. I'll pay 35x PE for Amazon because I know it's going to be here. I'm not even going to risk, whatever on this some company that I've never heard of that trades on the OTC. And it's like, well, so is that an opportunity, or is it like, okay, good thing I'm a fundamental investor because I'm used to waiting 10 years to collect on a lot of cases. And is that where we're at? But I see that as a nearer term, it should trade up because the data and its efficacy for treating this acute syndrome is increasing, but it hasn't happened yet because there's so much trepidation on the risk on appetite in the market. So I guess what I'm asking, if there's a question in there, it's like, should I be sort of, a little bit more conservative too? Or is this my opportunity to rush in and accumulate, to be greedy while others are fearful?
Why don't I start on this one? If I was an investor, if I was a regular investor, I would be waiting right now. I would wait to see. I would wait for a little more clarity. And I would rather not get the best price, but I would rather get a little more clarity, because otherwise you may end up having your money sitting in the same spot or maybe go lower for quite some time. And nobody wants to see good amount of money parked uh, and not go anywhere. And we may be in a period where for the next year, 9 months to a year, we may be just drifting. Not necessarily losing money on your investment, but not making any. It may take a while for things to assimilate once again. This is as Jeff said, and Lance said too, this is not a typical, this is not a little minor hiccup. And yeah, we have the trade war, which is not really going nearly as well as President Trump has been projecting. So there's a lot of vulnerabilities. And James, I don't have to remind you the amount of debt we're putting this country in, or the world in right now. and where it was before this started. And obviously it's not getting any better. It seems like whoever's in charge of the global American Express is issuing money without asking for it back, if you know what I mean. So the point of the matter is that we just don't know. It's just too much uncertainty to take long-term bets, in my opinion. I think you really are betting against the unknown right now. And I personally would not do that till I have some more clarity. Even if it comes at the expense of making less money, I would rather make less money but have more certainty and not sit on that money for extended periods of time that's not needed.
Mm-hmm. And you, Lance?
One thing I've noticed, especially with let's say these smaller companies that aren't getting a lot of love or that don't trade necessarily a whole lot of volume right now, is that you've had rotation in the market, right? And when there's a spotlight on them, most of these smaller companies, you'll see them start moving up and they'll start to catch a bit. But right now, I just think there's so much focus elsewhere, like especially on your big five, your Microsoft, Amazons that are really holding up the market, that you're having that whole sector of, let's say, newer, smaller companies just not getting shown love right now. They're not trading volume. There's not a lot of eyes on them. So actually, to make the bullish case, when nobody's showing that sector or these companies love, is usually the best time to start, scaling in them. Because when they do and everyone's hopping on them, here you are on the early stages. It's like what Roger said. It's just the timing period. Will that happen in the next 6 months or year? I don't know. Will you have to sit on it for years? Timing is very crucial, and timing is so difficult right now. I mean, I trade a lot of retail stocks like your Macy's, Gap, Under Armour, and I can know these companies are probably going to go down in the next year or so, but in the short term, it's very hard to play because you'll have these short term pops, and you're like, man, is this for real, or is it just a short term pop in a bear market or a bear sector? Again, timing I think is important, but I don't think you get scared and get shaken out, so to speak. If you're in, let's say, a company that's really not doing much right now, always know your time horizon.
You bet. Closing thoughts, Jeff?
I think that I know your track record as an investor, James, and it's great. So stick to your instincts, do what you do, but don't become a investment or trading tourist. Don't like, oh, Jeff knows how to, swing trade ETFs. That might be cool.
I think I'll try that today.
You know what I mean? Like the reason you're a good investor is because you have that vision of this fundamental case will be, over the long run. And what Roger's saying is also correct. Like to be defensive now is important because, as we all know, you could be right eventually and still lose your, everything. And so to not be a little bit careful and tactical in your timing, that's why I say it's a trader's tape, because the big thing about being a trader is that you have to be tactical in your entry. Whereas in a normal tape, in a normal market, you can be a little bit price agnostic if you have a good fundamental thesis. That's not the case right now. You could have the perfect fundamental thesis and get your face ripped off if you suck tactically.
You bet. All right, gentlemen, the market is now open. Let's leave it there for now. And thank you very much for your very insightful input. I look forward to speaking with you all later in the week. Thank you.